Let's talk about the Bank for International Settlements, or BIS, on Sunday, yesterday, held its annual general meetings where its new economic report for 2023 was released. The new BIS report had a chapter dedicated to the intertwining relationship between fiscal and monetary policy, and speaking to how the two should work together in the interest of economies and the global banking system. Here is Claudio, Borio, the head of Monetary and Economic Department at the Bank for International Settlements. Let's take an excerpt from his presentation.
Stylized projections underline the long-term risk to government finances. In this graph, we see that even if interest rates stay below growth rates, absent consolidation, debt to GDP ratios are set to climb in the long term from their current historical peaks, the red lines. The increase would be substantially larger if one factored in the impact of aging populations, the blue line, and those of the green transition and of higher defense spending linked to possible geopolitical tensions, the purple line. Should interest rates exceed growth rates again, the self-reinforcing dynamics would be naturally much stronger. Moreover, as we see in this graph, it is not uncommon for the differential to switch sign. To get a sense of the possible impact of high debt, this graph illustrates that if today interest rates were as high as those in the mid-1990s, which was a kind of typical level, I would say, all else equal, debt service burdens would, over time, exceed their historical peak. This grim outlook for government debt is quite worrying. It raises serious risks for price and financial stability. So let me consider each in turn. Fiscal policy can greatly constrain monetary policy in its fight against inflation. Within a certain range, the constraints are manageable. Expansionary fiscal policy increases the required degree of monetary policy tightening, but only to a limited extent. Central bank independence can provide sufficient safeguards. But when the credibility of fiscal policy or the creditworthiness of the government are lost, monetary policy can be hamstrung. A tightening would only heighten those concerns and fuel inflation, typically through an uncontrolled exchange rate depreciation, a form of fiscal dominance. As we see in this graph, stylized empirical evidence is consistent with these considerations. The inflationary impact of fiscal expansion is greater when the fiscal regime is less concerned with fiscal sustainability, as denoted here by spendthrift rather than prudent. The yellow bars are higher than the green bars. Moreover, extreme situations aside, central bank independence is key. The right-hand bars are considerably higher than the left-hand ones. Fiscal policy can also constrain monetary policy by triggering or amplifying financial instability. The direction of causality between fiscal policy and financial instability goes both ways. On the one hand, high sovereign indebtedness can cause financial system stress by generating losses for financial institutions, either because of their exposures to sovereign debt or simply by destabilizing the economy. This is a key reason why government and bank credit ratings tend to co-move, as illustrated in this graph for advanced economies. On the other hand, financial system stress, regardless of its origin, can cripple fiscal soundness. It can do so directly, as the sovereign may need to backstop the financial system, and most importantly, indirectly, as the economy tanks. As we see in the right-hand panel, the surge in public sector debt following banking crises is typically well above 10 percentage points of GDP in both advanced and emerging market economies.